Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended February 14th, 2017. Initially, we'll just talk about mutual funds, but certainly we'll put in the concept of ETFs in there throughout the presentation. I don't think people will be too surprised that it was really kind of a ho-hum week. Even, we saw about $570 million of net new money come into the conventional fund business, but this is just on kind of the back end of what we've been calling a rally that's been going on since the presidential election. This week we actually heard some good news. Basically Donald Trump came out and talked about a fantastic tax plan that he's going to unveil here in the next couple of weeks, and I think that piqued investors' interest. But of course, you want to see really what he's planning before you get too exuberant about it. We also heard Yellen become a little bit more hawkish than normal, basically saying, hey, we could raise interest rates sooner than many people are expecting in a recent talk, and we had good retail sales. And how this really kind of panned out is that we saw banks and some out-of-favor groups, industrials, actually do pretty good during the week as far as performance and also as flows. Let's take a look at our macro groups to see how the flows actually panned out. When we take a look at equity funds, we saw about $600 million of money leave the coffers out of that group. We'll talk a little bit more about that as we go on. Taxable bond funds took in $3.3 billion. Muni bond funds took in about $500 million. And money market funds, I guess, was the pariah of the group, losing about $2.6 billion. And really, that's not too surprising either. People are putting money back to work, and they are certainly on equities on the ETFs. We'll get to that in just a second. Let's go ahead and take a look at the equity fund macro group to kind of get more detail what happened. We actually had second consecutive week of plus side returns, 2.03% for the week. Again, we really have had a pretty good rally. We've had 5 consecutive days that we've hit records in the Dow, the S&P, and the NASDAQ, and that's not been seen since 1992. So it was a week of actually fairly strong returns, but investors, again, are waiting to see what the details are. And when we take a look at this, we saw about $590 million in outflows. I said that a little bit earlier. It's the 6th week in 7 that we've actually seen outflows out of this group, and really it's a much longer time period than that we've actually seen outflows. Domestic equity funds was the prior of the group this week. $1.1 billion came out of that group, and that's the 7th consecutive week that we've seen outflows out of that. And then we take, by the way, 2.32% return. We take a look at the non-domestic group, non-domestic equity group, actually took in $481 million, so it was on the plus side, but had a lower return. And this is the second consecutive week we've seen plus side returns here, but this one to the tune of just 1.41%. So when we're taking a kind of look at what's been going on in the markets, we like to take a look at the groups underlining these macro groups, and we saw that the large cap funds actually saw once again, it's been the biggest loser of money over the last several months. When we take a look at it, about $1.3 billion came out of that coffer. On the flip side, if we take a look at it, international equity funds actually took in about $1.1 billion. So this is really a dichotomy we've been seeing for quite some time. Let's take a look at the equity ETF group, and this is what I told you, that we've actually had inflows when we've been having outflows on the retail side. But equity ETFs for the 3rd consecutive week saw inflows this week to the tune of about $12 billion at the top of the group, as it's been in the kind of story when we see big inflows. Spider S&P 500 took in about $3.2 billion. The Financial Select Sector Spider Fund took in about $1.2 billion. And at the bottom of the barrel, even though we saw, again, record highs in the Dow, we saw the Dow Jones Industrial Average ETF by Spider lose about $2.1 billion, and PowerShares QQQ Trust 1 lose about $530 million on a total. So really we do have some 2 events going on. Retail investors still appear to be ducking for cover. Authorized participants, those people buying ETFs and destroying ETFs, the institutional end of that arm, basically putting risk back on. Let's take a look at the fixed income portfolios now to see what happened in that group. Fixed income funds for the 7 consecutive weeks, so about $3.3 billion come into that group. Again, this is conventional fund business only, ex-ETFs. We'll talk about the ETFs in just a second. It's the 4th consecutive week we've seen inflows in that group. Our 7th consecutive week in that group, but it's the 4th consecutive week of plus side returns, this time 0.16% return. And as has been the case over the last several weeks, corporate investment grade debt funds actually took in money, $2.3 billion, 11th consecutive week they've taken in money. And the underlying kind of theme behind there is loan participation funds. For the 14th consecutive week, they saw $744 million come into that group, and that is a subset of corporate investment grade debt funds. On the bottom side of it, though, we did see some outflows out of two groups. The primary group, though, was government mortgage funds. They saw just $174 million leave their coffers. Well, let's go ahead and take a look at what happened on the fixed income ETF side of the business. We saw about $1.6 billion come into the group. Fourth consecutive week, they've taken in net new money. iShares Core U.S. Aggregate Bond Fund took in about $354 million. The Spider Barclays High Yield Bond Fund took in about $221 million. And at the bottom of the group, we saw iShares iBox High Yield Corp lose about $358 million. And that's not really too big of a story. You know, we get a little noise as investors switch on, especially on the authorized participant side. So a little bit of noise here. We saw, high yield at the top and the bottom. I don't think there's anything meaningful in that at all. Let's go ahead and take a look at our Muni Bond Fund group and see what happened there. For the sixth consecutive week, we saw inflows. This time, it was $468 million. Not a bad chunk. First week in three, though, that they've actually had negative returns, and that was to the tune of 0.34% loss. Now, digging down a little bit deeper, we see that high yield funds accounted for the lion's share of all inflows, about $461 million. It's the sixth consecutive week they have taken in money, so certainly investors are putting risk on in order to get that higher yield, and certainly with the tax-exempt higher yield and right around tax time, if you'll call it that. We're a little bit early to call it tax time, but certainly investors start thinking about tax-aware issues as we approach the deadline of March for corporations and April for the retail individual taxpayers. Let's go ahead and take a look at money market funds now. And remember, I told you this is the only outflow that we really saw that was significantly large. Second week in three, we've seen outflows $2.6 billion this week, and taxable money market funds lost about $2.9 billion, while tax-exempt money market funds took in about $295. However, if we take a look at the taxable bond fund side, we see a little bit of a different story. Basically, we saw about $130 million of money go into institutional tax-exempt money market funds, and this might make sense as investors are actually receiving 401k money and putting it to work. That's considered kind of institutional flows as well. When we take another look at the retail side, we saw about $3 billion in outflows, and that brought us that $2.9 billion as far as outflows go. Well, that's it for me this week, but one of the things that we actually saw this week, and we're taking a look at just at the end of the week, is really how the market's reacting to the 5 consecutive days of record-setting trends, and with a 3-day holiday. President's weekend's coming up. President Monday is coming up on Monday. And I think investors are taking the foot off the pedal to see what this long 3-day holiday is going to do. So until next time, though, and if you want to do a deeper dive and find an area that I did not cover, you can go to easy for me to say, www.lipperusfundflows.com, or join us next week when one of our analysts will talk about the trends and flows of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.